This is Al Brooks. Thank you for watching the Brooks Trading course. This video is about the setup that I use every day when I'm trading. This is a picture of me inside my office, and you'll see there are two laptops in front of me. I use this one for trading, and that one I use for the chat room. It has a couple extra charts, 15-minute chart, 60-minute chart, and a daily chart. And I keep the blinds closed. Actually, I have shutters. I keep the shutters closed, and I don't take calls except for my kids, and I certainly do not watch television. I always ignore the news, and I certainly ignore the pundits on television. I don't want any distractions, and I don't want to hear anybody else's opinion. And I am very focused when I'm trading. My goal is to take money from your account, from everybody's account, and put it into my account. And your job is to take money from mine. That's the game that we are both playing. On my 5-minute chart, which is the chart I look at all day long, you see that there are some lines. This blue line is the 20-bar exponential moving average. And then I have another blue line down here that is dotted, and that is the 60-minute 20-bar exponential moving average plotted on the 5-minute chart. I wrote a TradeStation indicator, which I will show you in a couple minutes, that plots the 60-minute moving average, the 60-minute 20-bar moving average on the 5-minute chart, and it's very accurate. And then this other line, I don't pay as much attention to it, is the 20-bar exponential moving average on the 15-minute chart, again plotted on this 5-minute chart. Now look at this. Here's my chart. And this might be your chart. And you say, wait a minute, Al. All my bars are above the moving average, and a lot of your bars are below the moving average. What's going on? And one of the things could be that you're using a 24-hour chart, a Globex chart, but I only use the day session chart. So my moving average is calculated on bars that do not include the Globex session. Especially in the first hour or so, the moving average is very different on a Globex 24-hour chart than it is on a regular trading hour chart. And also, you may be using quarterly charts based upon December or March or June or September, and I use continuation charts. So if you see differences between my charts and yours, those are probably the reasons why. This is my setup when I'm trading the euro versus the dollar and all forex pairs. And you can see there are 3 lines on the chart. Again, this is a 5-minute chart. If you're ever in my trading room, my screen looks something like this. Sometimes I change it, but basically this is my screen. I have a 5-minute chart. I pay a lot of attention to trend lines, measured moves, and prior highs and lows. And you can see the 3 moving averages, the 5-minute 20-bar exponential moving average, and then the moving average on the 15-minute chart. And then this blue dotted line is the 20-minute moving average on the 60-minute chart. I have a 60-minute chart here, a 15-minute chart here, and then a daily chart of the E-mini here, and then weekly and monthly. The screen that I now have, I don't show the weekly and monthly charts because the screen is too crowded. I mentioned that I wrote a formula or an indicator in TradeStation that allows me to plot pretty accurately the 60-minute 20-bar exponential moving average on a 5-minute chart. You cannot simply copy this and paste it into TradeStation because of hidden formatting codes, so you have to type it out every little character one at a time. This is a comparable indicator. It allows me to plot the 15-minute 20-bar exponential moving average on the 5-minute chart. If you're not comfortable with code, or if you have a different broker and a different charting package and different indicators, you can approximate the 60-minute exponential moving average on the 5-minute chart by using, on the 5-minute chart, an exponential moving average set to 240 bars. There are 12 5-minute bars in an hour times 20 bars, so 240 bars on the 5-minute chart gives an approximation. Without going into the math, that number is always too high because on the 5-minute chart, you have a lot of overlapping bars, and the 60-minute chart only looks at every 12th bar on the 5-minute chart. So the number is never 240. You're actually better off using a smaller number like 220. That is a more accurate number if you're trying to get an approximation of the 60-minute moving average on the 5-minute chart. And the same is true for the 15-minute. You can say a 15-minute is 3 times bigger than a 5-minute, so 3 times 20 is 60 bars in your indicator. But because of overlapping bars on the 5-minute chart that get ignored on the 15-minute chart, using a number smaller than 60 is more accurate. 50 is usually better than 60. I also look at daily charts, and on the daily charts, I do look at the 20-bar exponential moving average quite often, but when I'm trading stocks, I add simple moving averages as well. For example, a 200-bar simple moving average. If this is the daily chart, that would be a 200-day simple moving average. Here's a 150-day moving average there. And the pink line is a 100-day simple moving average. And then this faint gray line is a 50-bar simple moving average. And they're there because a lot of stock market traders trade them. You can see how the market hits the pink line, the 100-bar moving average, and goes up, goes up, it goes up. And then here it fell below the 100, but turned up at the 150. When I look at the Euro daily, weekly, and monthly charts, and these are the four that I typically look at, I have to say that I pay much less attention to these moving averages on the daily, weekly, and monthly Forex charts than I do on stock charts, because I think Forex traders pay less attention to them. This is Al Brooks, and thank you for watching the Brooks Trading course. This video shows my setup. This is Al Brooks. Thank you for watching the Brooks Trading course. In this video, I'm going to be talking about program trading. First, I'm going to talk about what exactly program trading is. Next, I'll talk about high-frequency trading. Then I'll talk about spoofing, which is now illegal. And finally, I'll talk about front-running and high-frequency trading firms. Front-running is also illegal. Program trading simply means that institutions are using a software program that they wrote to trade automatically. It's automated trading. And the software logic is called an algorithm, and algorithms are based upon every imaginable concept. Even in quiet trading range, when it appears that nothing is happening, algorithms are still buying and other algorithms are still selling because there's an opportunity to make money. It may be difficult for you or me to make money when the trading range is very tight, but high-frequency trading firms can make money. There are countless firms buying and countless firms selling in every bar during the chart. Traders are always wondering about a perfect entry, a perfect setup. But the reality is there are no perfect setups. And if you look at every bar in the chart, there's a lot of volume. And that's because the institutions see reasons to buy and reasons to sell at every second during every day. The institutional bearish programs are fighting constantly to create a downside breakout. And the institutional bullish programs are constantly fighting to create a bullish breakout. Eventually one side wins and the other one covers. So the bulls get their breakout, the bulls buy more, the bears buy to cover their shorts. In this case, the bears got a bearish breakout, the bears sell more as it goes down, and the bulls who were buying now have to sell out of their losing longs. The bulls give up, the bears keep selling, and then with a bull breakout, the bulls keep buying and the bears give up. Here are two charts. I want you to take a look at them, and you'll see they're very similar. One is the SPDR, the SPY, which is an ETF, an exchange-traded fund, created to mimic the price of the S&P 500, and so is the E-mini. The E-mini also tracks the S&P 500, so these two charts are very closely related. Some firms specialize in arbitrage trading, and what they're doing is looking at two related markets to see if one of them is not synchronized accurately or closely enough with the other. And throughout the day, there are tiny discrepancies between related markets. I'm showing these two, SPDR and E-mini, but other related markets are the NASDAQ, or just about most major stocks, the Dow Jones Index. There are all kinds of related markets. And the arbitrage firms have algorithms, computer programs, that know exactly what the price of one will be when they see the price of the other. And if the price is not where it's supposed to be, let's say it's too high, they'll then sell the high one and buy the low one, hoping that and expecting that the two will get back in line. So they're looking to make tiny profits, and they do it all day long. And that is why related markets have charts that are almost identical like this, because the arbitrage firms are constantly looking for tiny discrepancies between related markets, and then they fade them. So if the SPDR is a little too high relative to the E-mini, they buy more E-mini and they sell SPDR until the prices are the same, and then they take their profits. This is an important component of the total volume of every day. Some estimates say that 30% of all trading volume is arbitrage trading. You can also arbitrage the E-mini with a portfolio of stocks. The computers might have designed a portfolio that they intend to have track the S&P. And if it's out of whack, if it's not synchronized the way it should be, let's say the stocks are getting too expensive relative to the S&P, they might sell stocks and buy the E-mini until it's back in line. All day long, they're looking for tiny discrepancies between related markets. And that's what keeps markets close to a fair value. High-frequency trading firms also monitor related markets for little discrepancies, and they, as well, trade arbitrage looking to make small, quick profits. All the institutions run programs. They all have automated trading. Many of them also have discretionary trading, where traders sit in front of a screen, the way I sit in front of a screen and place trades. But most of the volume that we see traded every day in the E-mini is traded by programs. And those trades, everybody's trades, creates price action, and everyone can see it. And if you learn how to read the charts, you can piggyback onto their trades. But it's really important to learn how to manage your trades closely. So for example, when I see this, I know there are a lot of buy programs working right now, and the market's probably going to go higher. What am I going to do? I'm going to buy, right? And one easy way to do it is wait for the bar to close, and if it closes near its high, you buy the close. Even buying here is okay, because the odds are the first reversal down will be bought, and worst case scenario, you get out break even. Most traders, not most, but a lot of traders who buy the close in a situation like this don't buy a full position. They buy small enough so that they can buy more if the market goes against them. And then when it gets back to their first price, they can get out break even on their first entry, and then with a profit on their lower entry. So you bought the close, and you bought more on this close, and then you see this bear bar right after you bought the close. Are you feeling happy, or are you disappointed? You're clearly disappointed. You're disappointed by the follow-through. And because you're disappointed, you might start selling every time it gets back to the original entry price. And that's what's taking place here. Instead of the market continuing up, bulls keep selling out of their longs. So they sell here, they sell here, they sell here. And at some point, they might give up completely, and then you get a reversal down like this. And this represents the final bulls, the bulls who did not take these opportunities to sell. They're finally giving up after they see the market repeatedly try to go up and fail. The bulls give up here. The bears see it as well, and they're selling at the same time that the bulls are selling. So the bears say, the bulls are going to be disappointed. They're going to try to get out break even. I'm going to sell exactly where they're trying to get out. If it goes up there again, I'll sell again. If it goes up there again, I'll sell again. And if it starts to go down, I'll sell even more, trying to force all the remaining bulls out. So you get a give up situation like this, a bear breakout. Traders, when they start out, sometimes think that maybe their trade will move the market. And the reality is you cannot move the market. Maybe if you're trading some tiny stock, but if you're trading a major market like the E-mini, you do not have enough money, and every person you've ever met in your life does not have enough money. If all of you got together, you could not move the market, even one little tick. If you want to sell at a certain price, you cannot sell unless one or more institutions wants to buy at that price. And if you want to buy at a certain price, you cannot buy unless one or more institutions is willing to sell at your price. If you're trying to get stopped out of a bad trade, the market cannot get to your price unless one or more institutions wants it to get to that price. You will not get stopped out unless one or more institutions get stopped out as well. That's not absolutely true, right? But it's true 99+% of the time that you cannot move the market. The market will only go to a certain price if institutions make it go there. Remember, I said bulls will buy closes, and then they get disappointed by this. And the bulls finally decide to sell at break even. They finally give up, the bulls who bought here. And look at this bar. This bar, let's say the bulls kept waiting. I'm not going to give up. I'm not going to give up. I'm not going to give up. And then look at this bar. It had to go above the high. It had to go above the close here if they bought this close. It had to go above that close for them to get out break even. If at the end of this bar, they decide, okay, I'm going to get out break even. I'm going to place a limit order to get out at the same price where I bought. So they place a limit order to get out there. But this bar did not get above that limit order. And why did it not get above that limit order? Because too many institutions wanted to sell lower. Too many institutions wanted to sell at that price or below that price. And if you were a bull who bought here, or bought for any reason, a high 1 buy, a high 2 buy, and you see this reversal, you got to get out. And these two bars are give up bars. The bulls are giving up. Now, I said a moment ago, you cannot move the market. If you want to buy at a certain price, whether to get long or to get stopped out of a bad short, the market will not get to your price unless one or more institutions wants to buy at that same price. This is definitely true in major markets like the E-mini. At every given price, there are hundreds, sometimes thousands of orders from institutions at the market, one tick above the market, one tick below the market. And if you're trading 1 lot, 10 lot, or 100 lots, 100 contracts, you're not going to move the market because there are thousands of contracts who want to do the opposite. So you don't have to worry that, oh my gosh, if I buy 10 contracts, the market's going to go up and I'll get trapped and the market will go down. If you trade 10 contracts, the market doesn't care. You're totally nothing as far as the market is concerned. So here we have a rally, 5 consecutive bull trend bars, all closing near their highs. 3 of them are pretty good sized bars. Chances are the first reversal down will be bought. Let's say you don't like entering with limit orders. Let's say you don't like buying at the market or buying the low of this bar, and you only want to buy with stops. Well, you might buy with a stop just above the high of this pullback bar. If you get filled just above the high of this bar, you get filled over here. It only got there because other institutions wanted to buy at the same price. That's not 100% true, but it's 99% true. You should always assume that if you buy, the only reason you are able to buy is because there were other institutions. There were institutions that wanted to buy exactly at that price. Every now and then on the news, you'll hear about some big cheater getting arrested and tried and convicted. And that obviously creates the question, can firms cheat? Can they steal my money? The United States markets, all the United States major markets, the stock markets, the bond markets, the Forex markets, everything is closely regulated and it's not a problem. Even though you occasionally hear about big insider trading cases or spoofing cases or market manipulation cases, it has nothing to do with you and me, and it's not going to cost you any money. All of the common ways that firms use to cheat are illegal. Insider trading, front-running orders. You place an order, the firm sees your order. They do not put your order in the market. They place one right before yours, and then the market goes, let's say you want to buy it, the market goes up, and then they fill your order at a higher price. That's all illegal. Spoofing, putting orders in the market to trick people into thinking that you seriously want the order to get filled, and right before it gets filled, you pull the order. Collusion with others to corner the market, getting a group of traders together to move the market in one direction, and then once it gets far enough, they do the opposite. And then in the Forex market, the price gets set every day at 4 o'clock. It's called the 4 p.m. London fix, and trying to cheat there, trying to artificially move the market one way or the other, up or down, that is also illegal. HFT, high frequency trading. There are books about it. There are movies about it. It's been on 60 Minutes. And it's a type of program trading. In fact, most of the volume every day in a major market like the E-mini and most of the stocks is created by high frequency trading firms. They scalp for tiny profits and they have a minimum effect on the overall direction of the market. The firms are simply looking to make one tick up or one tick down, and then they get out and then they look for the next trade. It's all totally automated and it's all statistically created. There was a book about it called Flash Boys and then a movie about it, but it has nothing to do with traders. I remember when the movie came out and the book came out, Michael Lewis was on a lot of talk shows and he made it sound like it's costing all of us money. But it's really foolish to say that because it really has nothing to do with traders. Flash money, Flash Boys, and high frequency trading firms, they're trading in milliseconds, in fractions of like a tick or a piece of a tick. And that's not our time frame. We operate in minutes or hours, not in milliseconds. So anything that they do that takes place in a millisecond is not going to cost us any money. It's only relevant to high frequency trading firms. But he sold a book, he made millions of dollars, he got a movie, and it makes a good story. It does not affect us. Whenever you hear about Flash Boys and Michael Lewis, go see the movie, it's fun, but it has nothing to do with you or me as a trader. There really is no typical high frequency trading firm, but this is a fairly common approximation of what a high frequency trading firm might do. They might make millions of trades a day, even 50 million trades a day, and they may trade 100 to 300 shares per trade, and they may be trading a basket of 1,000 stocks or 5,000 stocks. And here's a percentage of asset classes traded by prop firms, high frequency trading prop firms, mostly stocks, but Forex markets will become increasingly important as time goes on. They don't have to be right 60 or 70 or 80% of the time. A casino does not have to win 60 or 70 or 80% of the time, right? A casino only has to win 52, 53% of the time to make a lot of money. High frequency trading firms only have to be right about 55% of the time to make a lot of money. As long as the risk versus the reward is good, they're not risking too much for the reward that they're getting, they can make money by being right only 55% of the time. And a lot of times they're trading for one tick or one penny. But if they do it 50 million times a day, it adds up. In the E-mini or the stock markets, they might contribute 70% of the day's volume. And other institutions create about 25% of the volume. And you and I make up the final 5%. And I'm not even certain that we make up 5%. It'll probably get less as time goes on. Now, the flash crash back in 2010, this got a lot of attention, and the market fell about 100 points, 99 points, or 10% in just a matter of minutes. In fact, at the end here, it fell 60 points, 6% in 10 minutes, and then it rallied back 66 points. So that was a crash. The market fell a lot, about 10% in a short period of time in one day. And there's been some analysis of that particular day, and what they discovered were that 15 firms, only 15 high-frequency trading firms, that's all it took. They traded 34% of the volume. They traded 33% of all trades, and they averaged about 32,000 trades that day. What's really interesting and really important is this. They traded 6 contracts on average per trade. So high-frequency trading firms, you think, oh, they're big boys on Wall Street. They're trading hundreds of E-mini contracts at a time. No, they're not. They're trading 2, 3, 5, 10. On the flash crash day, they averaged 6. When they're trading stocks, are they buying 1,000 shares of Bank of America, Apple? No, they're trading 100 shares, 200 shares, 400 shares, 500 shares. But they're doing it millions of times a day. On that same day, the flash crash day, individual traders made up only 1% of the day's volume and only 2% of the trades. And the average trader only took 1 trade that day. And the average size trade was only 1 contract. So are we important? No. Compare that to just 15 high-frequency trading firms. There are probably 200 major firms trading every day on Wall Street. 15 of the firms had a third of all trades on the flash crash day, and we individual traders only made up 1% of the volume. The market is controlled by institutions, and most of the volume is coming from high-frequency trading. Next, I want to talk a little bit about spoofing. Spoofing makes looking at volume pretty much useless. Firms are not stupid. If you're a firm, you know that other firms are out there using volume to make decisions on trades, and that creates an opportunity to spoof them, to fool them, to trick them. So you create fake orders to trick other firms into doing something that their algorithms want them to do. You know what an algorithm might be doing at another firm. You don't know that firm XYZ down the street has a particular algorithm, but you know that there is some firm out there who will run different algorithms, and you design algorithms designed to counteract them, and you're trying to trick them into making bad trades. There are lots of variations on it, and they are all illegal. However, I'm sure that there are variations of it going on all the time. However, it does not have any significant effect on you and me. Here's an example. Here's the current price. Let's say this is the current price. So ignore all this stuff to the right. This instant, let's say a spoofing firm wanted to buy the E-mini, but wanted to buy it at a lower price. He could place a huge sell order just above, but with no intention of getting it filled. Traders who look at volume will say, wow, look at that huge sell order just above the price right here. If you see a huge order to sell right above the current price, do you think the market's going to go up, or do you think that huge volume order is going to push the market down? So let's say the market's right here, and the spoofing firm places an order to sell 500 E-mini contracts 5 ticks higher, or 1,000 E-mini contracts 5 ticks higher. But he has no intention of having the order get filled. Other firms see this order to sell 500 E-mini contracts, and they say, wow, there's some big firm who really wants to sell 500 E-mini contracts just a little bit higher. That means that smart, big money firm believes the market's going down. You see that and you say, oh, I better start selling. You're being spoofed. As the market's going up, you start to sell because you see this huge sell order just above, and that means some huge institution believes the market's going down. And as the market starts to go down, guess what? The spoofer who had that order cancels his order. And then he buys at the same time. So the order disappears, the yellow order up there disappears. And as the market's falling from these firms selling, the spoofer gets to buy lower than the price was when he put on the spoof over here. Because he put on that fake order up here to sell, other firms said, uh-oh, it's going down, I better sell here. So these firms sold here, and it allowed the spoofing firm to buy below what was the current price. So he gets to buy at a discount. And if you're one of those red firms who saw the spoofing order, not knowing it was spoofing, thinking it was real, and you see the order disappear, you're going to say, gosh, we've been spoofed, we've been tricked. You sold up here, and the big order disappeared, and you realize that you've been tricked, so now you're short, and you got to buy back your shorts. Those firms are buying, you're buying, the spoofing firm is buying, the market's going to go up, and it allows the spoofing firm to make money. Now, this supposedly was the method used by Paul Rotter, who traded German bonds. He also traded Forex contracts, and he got the nickname of the Flipper. And for a while there, he was making supposedly $60 million a year doing this. So you have firms who sold here. If they did not get out anywhere through here, they finally give up here, and the market goes down. And the spoofing firm who bought here is going to sell out somewhere up here. So the spoofer buys here. The market was here when he put on the spoof. Other firms sold heavily, drove the market down. The spoofer got to buy at a discount, and he was looking for a scalp. And when the market rallies, he gets to exit with a profit. The final thing I want to talk about is front running. Front running is illegal. The firm takes your order to buy. And remember, they have computers, and the computers are very fast. If the firm sees a lot of stop orders just above your order, it buys just before you. And then as soon as it buys, the market goes up, it immediately sells to you. It's selling to you after the market has gone up a little bit, so they're front running your order. So you place an order to buy. The firm receives lots of other orders to buy at a higher price, maybe on stops. The firm knows that, or their computers know that, and the instant that it receives your order, instead of placing your order in the market, it buys for itself. And the market starts to race up quickly, and then your order gets filled up here, and the firm pockets that profit. It might be a penny, it might be 2 cents, but if they do it many, many times a day, you're getting robbed a penny at a time, no big deal. But if they do it thousands or millions of times a day, they can make a lot of money. It sounds absurd. It sounds like it's impossible, but front running used to be a very popular approach, 50 years ago, 100 years ago. And then when the computers came out, it was also popular for a while, but it is now illegal. If a firm makes, let's say, a half a penny on 100 shares, then he's making 50 cents per trade. You say, well, that's not much money. You can't even buy coffee for that. But if he does it 10,000 times a day on all kinds of different markets, that adds up to $1 million a year in extra profit. So it's significant for the firm. It may not be significant for you, but it is very significant for the firm. And a bigger firm could make $2, $3, $4 million extra profit a year. High-frequency trading firms, they use really fast computers. This is not an exaggeration. This is what their setup might look like. They pay an incredible rent to be as close to the exchanges and the nodes, the internet nodes, as possible in New York City. Because the closer they are, the less time it takes to get trades filled and to get the latest trade data from the exchanges. And it's important to them to get even 2, 3, 4 milliseconds faster time. So they try to get as close as they possibly can. And they also buy the most expensive, the fastest computers that they possibly can buy. And a lot of their trades, they only hold for a microsecond, a tiny piece of a second. And a lot of their trades take place before a price change even appears on your computer. You see a price on your chart. It's not instantaneous with what took place on the exchange. It takes time to go up to the satellite to get sent over to your broker, and then broker to the satellite again, and then down to your house, or any way you do it. There are many steps in the way, and it takes fractions of a second to see a trade on your computer that took place a fraction of a second ago. And those firms are located right next to the exchange, and most of their trades take place before it even registers on your computer. So they're in and they're out before a trade even takes place on your computer. Now, are they taking money from the little guy? Is the market really that unfair? Remember, you and I and all of our friends are only about 5% of the market. So if you're an institution, are you going to look at us and say, wow, we're going to make all of our money off those 5% of the market, those little guys? No, we're a tiny piece of the pie, and that's not enough to feed all of those firms. They don't care about us. They cannot possibly make enough money from us. They have to make money from one another. Remember, they are 95% of the market. And to say that, oh, they're out to get the little guy, they don't care about the little guy. It's just an excuse for failing to spend the time necessary to learn how to trade. By the way, it does take a long time to learn how to trade. So all of those ads you see on the internet about making money after the first week, or learning just a handful of patterns, or taking a course that is an hour long, to me, I don't think that's possible. The people who make money spend hundreds of hours studying. They go through a course like this, they take lots of notes. Every day they take notes on what they're doing, and they study very, very carefully. Now back to a high-frequency trading firm. How much profit? Okay, let's say the firm took 10 million trades today, and each was for only 100 shares. Remember I said they trade small, but they trade often. They might trade 100 shares, 200 shares. 10 million trades today, and let's say they won 55% of the time. So 55% of 10 million trades means they won on 5.5 million trades. So they made a penny on 5.5 million trades, and they lost a penny on the other 4.5 million trades. So they won 55% of the time. So they won 5.5 million times today, and they lost 45% of the time. They lost 4.5 million times today. So they made $5.5 million, and they lost $4.5 million. So they ended up netting $1 million. But there are 200 trading days, approximately a year. So if they're consistently good, guess what? Trading 100 contracts or 100 shares or 100 anything, very tiny position, but you do it often enough and you win consistently, it can add up to a huge profit. A really good high-frequency trading firm can make hundreds of millions of dollars a year. Because some high-frequency trading firms make huge profits, lots of other firms say, hey, that guy down the street's doing it. I bet I can do it. I'm going to hire some smart programmers and I'll set up a firm and I'll start making $200 million a year. Well, the reality is, just like in anything else, only the very best make the biggest dollars. So only the very best high-frequency trading firms make hundreds of millions of dollars. And many other high-frequency trading firms actually lose money. Now, high-frequency trading firms, it's easy to listen to Michael Lewis and feel like they're taking all your money and that's the reason why you're not making money. They are not the problem. If you're not making money, they are not the problem. You are the problem. Everybody likes to blame their losses on somebody else, but if you lose, it's because you're not yet good enough. You got to put the time in to study. You got to spend a lot of time studying. The dollars are there. There are lots of dollars there, but you have to learn how to trade, and it takes a lot of time. In this video, I talked about what program trading is. I talked about high-frequency trading. I then talked about spoofing, which is illegal. And then I talked about front running, which is illegal. And I talked about high-frequency trading firms. This is Al Brooks. Thank you for watching the Brooks Trading course. This video was on program trading. This is Al Brooks. Thank you for watching the Brooks Trading course. I'm going to be talking about personality traits of successful traders in this video. I'll begin by talking about the traits that great traders have. Next, I'll talk about the importance of avoiding doing stupid things. And finally, I'll talk about the importance of being comfortable with uncertainty. You're never going to be as certain as you would like to be with anything in the market, and you have to learn to be comfortable with that. Great traders obviously are disciplined, they're objective, they're patient. As I said, they have to be comfortable with uncertainty because you're never going to be completely certain. There always has to be an institution believing the other side of what you believe to take the other side of the trade. Also, it's really important to become a great manager of your trade. Once the trade is on, you have to be able to do the right thing. When I talk about discipline, I talk about doing what is right, even when you do not want to do it. Traders oftentimes look at a market and take a trade thinking, well, maybe this time it'll work. And a disciplined trader never says, just this time maybe it'll work. A disciplined trader only takes trades that he thinks make sense, and he doesn't deviate from that. For example, we got two legs down, one pullback two, and maybe this is a sell climax, and maybe I should buy. Maybe the V bottom will work this time. I know the probability is in a tight bear channel with small pullbacks it won't, but maybe it will. So maybe I'll buy the high of this bar, just above the high of that bar, and maybe I'll have a huge win. I know I'm taking a low probability trade, but my risk is small. My stop is here, and maybe I'll make all this profit. So I have a great risk reward profile, and I don't care about probability. Maybe this time it'll work, right? There's never a maybe this time. You take a trade because you think it makes sense, and because it's consistent with the style of trading that you always use. Don't deviate from that. Don't say maybe this time it'll be different. If you normally only take high probability trades, don't take a low probability trade this time. It's really important to make sure that you don't let your emotions interfere with your trading decisions. If you feel anything, confused, agitated, upset, impatient, greedy, fearful, it doesn't matter. If you feel anything at all, then just wait. And it's very important to accept that no matter how confident you are that the market will do something, in 40% of the cases, it'll do the exact opposite. Don't feel that you're absolutely right and that something will work. And again, if you don't feel perfectly normal, don't take the trade. And certainly, if you are taking a trade, always be open to the possibility that the market will do the exact opposite. It's really important to be patient. Sometimes it can take an hour, 2 hours, 3 hours for a good trade to set up. Don't feel that you have to rush and take a trade. You trade what is there, and you do not trade if what you want is not there. So for example, pretty tight trading range, weak bull channel, low probability trading, mostly limit order trading, buying below bars, selling above bars. Higher probability to wait for a strong breakout or the follow through after a strong breakout and then sell. Yes, the stop is further away, so the risk is greater, but the probability of making money, if you sell at that close or as soon as it closes, the open of the next bar, the probability of making money is high. A trade is never overdue, but one always eventually comes. If you are a high probability trader, then you wait for a high probability trade. These are not high probability trades. These are risk reward trades. Small risk, big reward, but low probability. If you prefer high probability, you wait for a big breakout and good follow through. As soon as that bar closes, sell the market. You get filled right here. One of the important things is learning how to avoid doing stupid things. When traders start out, they often get excited and they rely more on hope and emotion instead of objectivity. For example, they'll look at this and say, we got 3 pushes up. 1, 2, 3, so it's a wedge top. And Al says it's always good to sell wedge tops. We got a bear breakout, and maybe this is a pullback from that breakout, slightly higher high. You can also call it a double top, a higher high double top. So maybe I'll sell that reversal down. And the beginner ignores the reality that there are 8 consecutive bull bars here and 6 bars without a pullback. And that makes this a very low probability trade. All the beginner sees is, well, if I sell here, my stop is here, and I'm not risking very much. Plus, my reward maybe is here, maybe more. So I have fantastic risk reward. One of the common things that all beginners do is they get excited and they ignore the third variable, probability. Whenever the risk reward ratio is fantastic, as it is here, chances are you're going to lose money. So here we have a second entry short. We tried to sell here, we try to sell here, so it's a slightly higher high version of a double top. So maybe it's an even higher probability short, but it's not. We have 8 consecutive bull bars. You should wait for either a series of bear bars and then sell, or a micro double top and then sell. And the beginner knows this. The beginner sees this and knows that the chances of a reversal are small, but all he thinks about is risk reward. Small risk, big reward. I'll take the trade. And he even knows that he has a pretty good chance of losing money. He senses that it's not a great trade, but he does it anyway because he knows the risk is small. And beginners only think about risk. So if a trade has low risk, the beginner will take the trade, even though the probability might be very low. And when the beginner takes the trade, it often takes him a long time to correct his mistakes. Again, he knows the probability is that he won't make money. That means the probability is that he will lose money. He still takes the trade, hoping that the market will do what he desperately wants it to do. He wants the great risk reward to pay off. But it's a bad trade. An experienced trader would rarely ever take this trade. Great risk reward, but terrible probability. The bulls look at this as a double bottom, a higher low double bottom, or a broad bull channel. High, high, higher, low, higher, low, higher, low. So they see this as a broad bull channel, and they see this as a pretty strong leg up. So they think the wedge top will probably fail. Again, we have 8 consecutive bull bars going up here. And at this point, it's an 8-bar bull microchannel, 8 bars without a pullback. That is a very low probability short. Look at the sell signal bar. It's a doji, plus it's following another doji. So not much selling pressure. Again, very low probability to take this sell. Also, look at the sell-off. It's not as strong as this rally. More overlapping bars, more small bars. And it's also not as strong as this rally. So to bet that the bears are suddenly going to get strong is a low probability bet. That means this is probably going to be a minor reversal, a bull flag, or a bull leg in a trading range. Low probability of making money. More likely going to be a pullback, and then the trend will probably resume up. So it's not a good wedge top to sell. Bad habits, like taking trades that you get excited to take because the risk reward is fantastic, bad habits are hard to correct. A habit is a result of behaviors that we use to function in the rest of our lives. We all have lots of habits and we like them. They're functional. The good habits are functional. They help us do well. They protect us, they make us happy, and as a result, we don't want to let them go. That is true with trading as well. So selling a wedge top, you really want to have it work, even though you know it's a low probability bet in this kind of context, but you take it anyway. Not only do you take it today, you take it again next week and the week after and the week after, and you keep taking it because it's hard to correct bad habits. But this is what is much more likely. The bull trend will continue up. If you make a mistake like that, even experienced traders sometimes do dumb things like this, stupid things like this, but experienced traders, as soon as they realize that they made a mistake, they get out. Let's say an experienced trader took that short, he might get out 2 or 3 ticks later, 2 seconds later, 5 seconds later, and lose very, very little. But a beginner often holds onto the position all the way up, hoping that maybe it'll come down. It's too far up, it's climactic. Maybe it's another kind of wedge, 1, 2, 3, maybe it's a parabolic wedge, and he just ends up losing an incredible amount of money. So his low risk trade turned into a high risk. As I said, an experienced trader quickly recognizes when he does something stupid and he admits it to himself. He does not punish himself, he just fixes it. He knows that the trade was probably self-indulgent and he just gets out. And he takes the loss and he doesn't care. He just moves on to the next trade. He might get out right above the high of that bear bar. It's a breakout pullback buy, a high one buy, in a pretty strong rally. I always think of the market with respect, and I think you have to look at it as if it's a parent or a grandparent or any other elder. You got to be respectful of it. And also, for me, if I ever did something disrespectful or selfish when I was with an uncle or a grandparent or a parent, I would feel terrible, and I would be very quick to fix what I did. I would be disgraced. I would immediately stop doing what I'm doing, and I would go on to do something else to make up for my bad behavior. And because I'm so respectful of them, I just can't imagine ever being so self-indulgent when I'm with an elder, someone that I should respect. And if I do anything wrong, I fix it immediately. So if I make a mistake shorting here, I'm not going to get out here. I'll get out above this bar or on this bull close or the follow-through bull bar. I got to listen to what the market is telling me. It's telling me that the market wants to go up. If anything, I have to get out at a minimum and try to get long. Start buying closes somewhere in here. Maybe I get out above this bar and wait a bar or two and then start buying closes. Markets have been around forever. People have been trading between one another since man has been around, tens of thousands of years. And markets have become perfected over time. Now they're really, really good. And just like an elder, the markets have been around a long time, and I think they deserve our respect. And you have to treat them appropriately. And they have behaved really consistently over thousands of years. And to treat them disrespectfully, you're going to lose money. So the bears are sold here. They finally give up. See this big bar here? This is the bears finally giving up. They're just buying back their shorts and taking their loss. As I said, I look at the market as I would any person deserving of respect, especially someone who's done something really well for a very long time. So if I do something wrong, I'm going to quickly fix what I did, even if it costs me money. One of the most important things as a trader is becoming comfortable with uncertainty. Only 10% of the bars on the chart have really high probability, a strong breakout. 90% of the bars on the chart are either in a channel or a trading range, and the probability that the market will go up or down fluctuates between 40 and 60%. So 90% of the bars look like this. The market's pretty much going sideways. Bear channel, bull channel, bear channel, breakout with bad follow-through, bear breakout, weak follow-through. And that means that the probability being between 40 and 60% during 90% of the day, you're living with constant uncertainty. And uncertainty is the only thing that's certain. Likewise, knowing how to live with insecurity, risk of losing money, is the only security. You have to be comfortable with taking risks, appropriate risks. Most trading is unclear, and Rarely is it more than 60% certain. You get clarity during strong breakouts when there are strong breakouts with follow through, but on any chart, that's only 10% of the bars on the chart. Here we got a few bars with a very strong breakout. The probability is we're going higher. But during these bars, only 40% to 60% chance we're going up, 40 to 60% chance we're going down. As a trader, you cannot be afraid of losses. You have to trade small enough so that if you do lose, you don't get upset. Losses are inevitable. Even great traders lose money. A really good scalper is still going to lose 10% of the time. Losses are inevitable. Even though some things are relatively high probability, nothing is really clear real time, but at the end of the day, if you print a chart out, everything is perfectly clear. However, you don't get to trade knowing what all the bars to the right look like. When you're taking a trade, there's always going to be uncertainty. You're never going to be more than 60% certain. Maybe during a strong breakout, you might be 70% certain. Another thing that's really important is you have to be comfortable with what you're doing. You want to do this for many years. You want this to be your career, and it has to be fun. So you can't be stressed out and worried and upset and agitated all the time. You have to find a way to trade that allows you to be relaxed, comfortable, happy. You're always going to be a little bit stressed when you have a trade on. That's natural. But it can't be so stressful that it's really unpleasant. You want to do this for years, so you got to make sure that you're trading in a way that's compatible with your personality. It often takes a few years to find out exactly what your personality is and what style of trading you should be doing. There are lots and lots of ways to make money as a trader. If you see somebody on television trading one particular way, don't feel that that is the way that you have to trade. You have to find something that works for you and something that's comfortable for you. And unfortunately, it takes a long time to figure it out. You can quickly learn lots of styles of trading: scalping, swing trading, fading, buying breakouts, selling bear breakouts. There are all kinds of things that you can do, using indicators, using dome trading, all kinds of ways to trade profitably. But that does not mean you're comfortable using any of those ways. You got to find a way, a time frame, a style of trading that works for you. And it takes a few years to really figure it out. Sometimes you get lucky and you do pretty well inside of 6 months, but it really takes a few years to get, I think, really comfortable with what you're doing. And you also have to study a lot. That's one of the reasons why this course has so many videos. There's a lot to learn. You don't have to learn all of it at once, but you need to put the time in. A lot of websites make it sound like you just study for an hour or two and you're going to make money. That's not going to happen. You're trading against really smart people with a lot of experience. And for you to make money, they have to lose money. They've been doing it a long time and they don't want to lose money, and they're very good at not losing money. So you have to get good too. On those websites that make it sound like you study for an hour or two or three or for a week or two and that's all you need, that's not true. Whenever you think that you're totally done, the Navy SEALs rule is if you think you're done, you're really only 40% done. There's still a lot more to learn. Most traders starting out find it easier to make money if they begin looking for swing trades, looking for big moves. But if you are a swing trader, you need to accept certain things. Remember, you're looking for a big reward. Big reward relative to risk means the probability is less. In general, when you take a swing trade, you only have about a 40% chance of making a big profit, a swing profit. That means you're going to be having small losses or small gains 60% of the time. Only 40% of the time, you're really going to be achieving your goal of a big gain. Most of the time, you're going to be losing or basically break even. You have to be able to hold your position for a long time. Here, you have to hold through 10 or 15 bars in a tight trading range. And the market constantly tries to reverse, bull reversal, second entry buy. Lots of bull reversal attempts here. Yet your fundamental premise is still unchanged. We have a bear breakout, and none of these bars is going above the top of the bear breakout. You have to have a personality that would allow you to hold for a big gain despite the constant reversal attempts. Scalpers, on the other hand, need a high probability when they trade. They're going for a reward that's small relative to risk, maybe about the same size as the risk, and that means they have to win very frequently. A really good scalper can win 90% of the time. And because most traders cannot win 90% of the time, most traders should not scalp. As a scalper, your risk reward is bad. Your risk and reward are about equal, instead of the reward being many times bigger than the risk. So you have bad risk reward and you need high probability. And that means you have to be good at finding high probability trades. And a lot of times they happen pretty quickly, so you have to make very quick decisions. Most traders cannot do that long term. By long term, I mean years. If you're going to be trading for years, you have to be comfortable doing what you're doing for years. And because scalping is a very difficult way to make a living, most traders should focus on swing trades. And the simplest definition of a swing trade is a trade where the reward is at least twice the risk. Some traders are comfortable trading in all environments. They take high probability trades, they take low probability trades, they swing some of the time, sometimes they swing part of their positions, scalp part of their positions. They're comfortable all the time, so they swing and scalp. Here they sell below the bear bar, reversal below the moving average. Here they sell below the bear bar, it's below the moving average. They know the probability is not high at this point, but the reward is big relative to the risk, so it's okay to swing. And then they see the market enter a trading range, and they stop swing trading and they switch to scalping. They say, well, that's not a very good looking sell setup, so maybe I'll buy below the low. This is a pretty good reversal up. Chances are we're in a trading range. If we go to a new low below that low, the bear breakout will fail, so I'll place a limit order to buy there, and I'll buy betting on a bounce. And if you did buy here, maybe you say, oh, it's been below the moving average, a lot of bars, maybe I'll just scalp out here. A bear might sell here, first touch of the moving average in a lot of bars, not a particularly strong reversal. And if he does, he might sell for a swing, hoping that we continue down, or he might sell for a scalp, betting that we're probably beginning a trading range here. A lot of the websites that talk about trading focus on trade selection, buy setups, sell setups. But in fact, that's not nearly as important as managing trades. The websites make it sound like there are perfect setups, secret setups that great traders have and they're not going to tell anyone. And that's just not the case. Most of the time, 90% of the time, a good trader can make money at any instant, buying or selling, if he uses a wide stop and is willing to scale in and he manages his trade correctly. Here we're getting a bear breakout below that low. Maybe you can sell that close. We have a pair of bear bars closing in their lows. And then maybe scalp out on the reversal up. We have a micro double bottom here. On the other hand, someone else could look at that same chart and say, a lot of trading range price action. I bet it's a limit order market. I bet if I buy with a limit order at that low and buy right here, exactly where that bear sold, I can make money. I'll buy more lower and scalp out when it gets back to my entry price. I buy more here and it gets back to my entry price. I get out break even on my first buy and with a profit on my lower buy. You can make money selling at that point, or you can make money buying at that point. And that's true for 90% of the bars on the chart. If you manage your trades correctly and are using wide stops and are comfortable scaling in, during 90% of the bars on the chart, you can make money. 10% of the bars on the chart, the probability is high that the market is breaking out and will continue further. So if you see a strong breakout, it's better only to trade in the direction of breakout. So 90% of the bars, you can make money buying or selling, but management is the key. 10% of the bars on every chart are in a strong breakout, either up or down. And when the market is in a strong breakout, it's better only to trade in that direction. After 3 or 4 bars down here, it's better only to be looking for shorts. Only 10% of the bars on any chart are in a strong breakout. In general, that's an average. Obviously, sometimes the market could be just trending very strongly up or down, and it might be 20% of the bars. But in general, if you have a chart on the screen with 100 bars on it or so, about 10% of the bars are in a strong breakout. 90% of the bars are not in a strong breakout. They're either in a channel, like this, or in a trading range. And when that's the case, you can buy or sell and make money if you manage properly. By manage properly, I mean get out when the premise is no longer valid, use wide stops, and be willing to scale in. In this video, I talked about personality traits of great traders. I talked about the importance of learning how to avoid doing stupid things. And very important, I talked about being comfortable with uncertainty, because as a trader, there are no perfect setups. And during 90% of the bars on the chart, the probability of making money buying or selling is between 40 and 60%. And the key is management, not trade selection. This is Al Brooks. Thank you for watching the Brooks Trading Course. This video has been about personality traits of successful traders. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 2 videos on starting out as a trader. I first want to talk about false beliefs that lots of traders have when they begin trading. Next, I want to talk about the big picture: buy low, sell high. Finally, I'll talk about chart types and time frames. One of the problems that all traders have starting out is they come in with a false belief. They believe that traders have secret setups and great ways to make money, that there's a golden goose out there laying eggs, golden eggs for a small handful of really good traders, really rich traders. And that's not true. There are no perfect trades. Traders are always asking me, Al, what's the best setup? And what they're asking me is, Al, how can I make a lot of money with very little risk and win a high percentage of the time? And the answer is you cannot. You certainly cannot do it as a trader, because there always has to be an institution taking the other side of the trade. So there are no secrets. There are no secret great setups. Everyone sees the same thing, and everyone is competing, trying to make as much money as we possibly can. Here we have a bear trend. We have a lot of bull bars closing near their highs. We tried to reverse up here. We tried to reverse up again here, and then again here. And we have a double bottom. Traders will buy above the high of this bar. Double bottom, lots of bull bars. Traders want to believe that there's some simple way to get rich, but there's not. Trading is always going to be hard, because there will always be equally smart, if not smarter, people and institutions believing the exact opposite of what you believe. Remember, if you're buying from someone, and that someone almost always is going to be an institution, and if that institution is selling, then that has to be a warning to you that maybe your perfect setup is not as perfect as you think. So in this setup, sure, it's a decent buy. Most buys, most sells have between 40 and 60% probability of being profitable. And that's true of this buy as well. But even if it's 50%, that means 50% chance it's not going to be profitable. And you have to be open to that possibility. Another thing that traders often erroneously believe is that there's a best time to enter. To wait for the right candlestick pattern and then buy or sell. But the reality is, if you look at the volume of these bars, the volume is big on all of the bars. And what does that tell you? That tells you that there's lots of trading taking place every second of the day. And that tells you that every second of the day, there are institutions who believe there's a good reason to buy, and there are other institutions that believe there's a good reason to sell. And if you don't take the first entry, no big deal. There are always countless other entries. Some bears will sell the breakout below this double bottom, others will sell this close, others will sell above this weak reversal. The bottom line is there's no best time to enter. Sometimes it might be easier emotionally than others, but you can enter at any time all day long as you structure your trade correctly. You first decide, do I want to buy, do I want to sell? Then you decide where your stop is going to be. Then you decide on your position size. And then you decide on your goal. Where do you want to take profits? The key is to learn how to read the charts so that you can see the reasons why institutions are buying and selling all day long. When you see a chart like this, every bar has a lot of volume. You know there are institutions finding reasons to buy, and there are other institutions finding reasons to sell. And all it takes is a little practice for you to see those reasons. And then you can enter at any time. You do not have to worry about taking the first trade or the first entry. There are always going to be other entries. So if you don't sell the breakout below the double bottom, sell the close of this bar. No big deal. You can say, well, that's not a very good looking buy. Well, then sell it. Sell above the high of this buy signal bar, betting that a pair of dojis is not enough to reverse this big bear bar. Also betting that we have a double bottom, a reasonable buy, and a big bear breakout. So you have bulls who are trapped in, desperate for any bounce to sell, and you have bears who did not take the original sell, desperate for any bounce to sell. Chances are you're going to have a second leg down. So sell above the weak reversal, expecting at least a little bit more down. And then you got trend resumption. We have a bear bar closing on its low. Sell below that bar. What's the big picture in trading? You obviously want to buy low because you want to sell higher. And if you're shorting, you obviously want to sell high because you want to buy lower. One of the most important concepts in trading is that you want to be buying at support and selling at resistance. But look at this. There is no resistance here. We're just racing up. During a bull breakout, the market races up to the next level of resistance, maybe based upon a measured move. So we got a breakout bar here, and the middle of the breakout bar, above the breakout point and the first pullback here or here, measured move from the bottom of the bull leg to the top of what could have been a top. Instead, we got a breakout, so traders expect some kind of a measured move up. All minor resistance, you have to expect it'll fail. When a bull trend is pretty strong like this, any reason to sell is bad. You should only be looking to buy because, yes, there's resistance. Here we got a double top. Here we got a triple top. Doesn't matter. In a strong bull trend where the pullbacks are very small and you have a lot of bull bars, very few bear bars, the odds are the market's going higher. All resistance will fail. So you see a wedge top, don't sell. Another wedge top, don't sell. The pullbacks are too small and no bear bars, just not enough big bear bars closing on their lows. Double top, do you want to sell? No. Double top, do you want to sell? No. Because all resistance will fail, whenever you see resistance and you see the market trying to reverse, you should look to do the exact opposite. You should assume that the reversal attempt will be a bull flag and look to buy. Trying to reverse, look to buy. Trying to reverse, buy, buy, buy. Trying to reverse, buy, buy, buy again. In a bear trend, the exact opposite is true. You want to buy at support, but you want to make sure that the market is starting to it's starting to show some signs of buying pressure. When the market is falling like this with the pullbacks being very weak, the buy signal bar is small, the channel down very tight, you don't want to be buying. The market is racing down to a support level. You may not know what the support level is, but it's there. A good place to look is a measured move. We got a breakout here. The market may have been bottoming here. We may have had a double bottom. Instead, we broke to the downside and had follow through. So this is probably going to be a measuring gap that will lead to a measured move down. Look at the start of the move and then look at the middle of the gap or the low of that bar and project down the same distance and look what happened. A lot of computers decided to take profits at that support level. And all of these minor reversals will fail. And instead of looking to buy every reversal or every wedge that you see, instead you should be looking for them to fail and then expecting them to become bear flags and look to sell. So we got a double bottom, failed. We have a wedge, failed. We have a wedge. We tried to get a double bottom here, tried to get a double bottom here, tried to get a double bottom here. We just keep breaking out below all prior lows. And we're forming gaps. This low, that high, very little overlap. This low, that high, the market is probably going lower. You have to find any reason to get short. And a good way to get short is to look for a reversal attempt up and expect it to fail, and then sell as it resumes down. Trying to reverse up, look to sell below that bear bar. Trying to pause, maybe reverse up, double bottom, look to sell. Trying to reverse up, look to sell, sell, sell. And don't look for wedge bottoms and double bottoms when a channel is as tight as this, because any reversal is almost certainly going to be minor, which means it'll become a bear flag and you'll make more money by looking to sell than looking to buy. With all trading, management is more important than picking the right entry. Remember I said you can pretty much buy or sell on any bar during the day. There are only 10% of the bars during the day that are breaking out strongly like this. And when that's the case, you only want to look to buy. But the other 90% of the bars, you could either buy or sell and make money if you manage your trade correctly, if you use wide stops, if you're scaling in. When you see a strong breakout, it's good to enter as early as possible. You can still make money buying this highest close, but your stop is still down here. And it would be better if you could buy more above a bull bar here or here. So you buy and then scale in, and then either get out of your original trade here, break even, and then with a profit here, or get out, break even on the first entry, and hold these for a swing up. If the risk is big, so you buy up here, and your stop is here, and it's much bigger than what you want, you can always use options for stock replacement, or you can just simply trade small. If this is a daily chart, and this is a stock, and it's racing up, and your stop is too far, you might instead buy calls or buy a call spread. If you miss the first entry, that's not a problem. Buy as soon as you possibly can. The key is to use the correct stop. Even if you buy way up at the top, the stop is here. If you buy here, the stop is here. If you buy here, the stop is here. It doesn't matter where you buy. All that matters is the price action, and this price action tells you the stop is here, maybe here. That is the important factor. You got to use the correct stop. And if the stop is very far, you have to reduce your profit target. You don't want to be using too tight a stop. For example, you don't want to be stopping out below this bull bar, because chances are double top, we're going to pull back a little bit. That's not the correct stop below there. The stop is down here or below here. Another thing that beginners often believe is that trading is relatively easy. If I learn a dozen candlestick patterns, that's all I need. If I take some trades that are mentioned on some website, that's all that I need to make money. But that cannot be the case, because there are so many institutions out there looking for every way to make money. And if you see a high probability way to make money, guess what? They see it too. And let's say you're buying and it's a high probability buy, they're going to stop selling to you. In fact, they'll buy with you as well. So it's a fallacy to believe that you can learn how to trade in a week or two, learn maybe a dozen candlestick patterns and then a few chart patterns on some website. You're not going to make money doing that. I'm absolutely confident that you cannot make money doing that. Trading is hard work. It has to be hard because you're competing against really smart people and they are not going to give you a penny. They're going to try to take every penny that they possibly can take. If you're out there expecting perfect trades, you're going to discover that no matter how perfect they are, they're going to lose money. So here we have a good-looking buy signal bar, maybe a double bottom, lower low double bottom. The bulls lost money. Another bull reversal, the bulls lost money. Why? Because the bear channel is tight and it's only good for bears to make money. Trying to buy in a very tight bear channel, the chance of you making money is small. When you're trading, as I said, you're competing against the best traders in the world, the smartest people in the world, and they're very good at what they do, and they're competing among one another. Any advantage that one firm has over the others is always going to be small. Everybody's edge is going to be small. And simply looking at candlestick patterns, it's a fraud. Any website that advocates buying, just look at a candlestick pattern and buy, it's a fraud. It's not going to work. You need context, you need management, and it takes a long time to become a good trader. That's why I have so many videos in this course. I'm giving you all the information that you really need to become extremely good. But you have to put the time in. Every trader tends to have favorite patterns. Every trader tends to have a favorite market. I trade mostly E-minis and Forex markets, especially the euro versus the dollar. But I also trade bond futures, crude oil, sometimes gold, and stocks and options. And I use the same techniques no matter what the market is because trading is genetically based. It's rational human behavior, and it doesn't matter whether it's trading playing cards as a kid, trading real estate, or trading stocks or bonds or futures or commodities. It's all logical, rational human behavior. So traders approach all markets with the same ideas, the same techniques. Take a look at these two charts. Which is the Forex chart and which is the gold chart? Are you going to trade one chart differently from the other if I tell you that one is gold and one is Forex? Of course not. You're going to trade them based upon what you see. When the market's going up, you're looking to buy. When it's going down, you're looking to sell. And it doesn't matter what the market is. It could be the housing market. It could be real estate prices in your city. And because you cannot tell which is gold and which is the euro versus the dollar Forex chart, you trade them the same. Forex, stocks, bonds, commodities, E-mini, stock index futures, they're all financial markets, and they all react to the same news. And they often trend at the same time, sometimes in opposite directions, but they all trend at the same time. And it does not matter which market you choose to trade. Every trader has a favorite. I trade mostly E-minis in Forex markets, but some traders prefer crude oil. Other traders prefer stocks. Other traders prefer ETFs or bonds. Doesn't matter. You're going to trade them the same. So if the market's selling off in the euro and in gold, you have to look to sell. So Forex, stocks, bonds, it's all one market. Look at this. This is all the same time. This market rallied, and these two sold off. This is the 60-minute chart of the dollar versus the yen, and it rallied very strongly. This is bond futures, and it sold off very sharply. And this is the E-mini, the stock market, and it sold off very sharply. When the bond market falls, interest rates rise. If interest rates go up, traders buy bonds, and they need to convert to dollars if they're buying American bonds, and therefore the dollar rallies. Higher interest rates, so less money available to buy stocks. Money costs more, and also CDs become more attractive, so traders take money out of stocks and put them into CDs. You can argue fundamentally what's going on here, that it makes sense. The bonds sell off, interest rates go up, the dollar goes up, and stocks go down. I never trade that way. The point I'm making is that all financial markets are related, and if one market is moving, probably all other financial markets are moving as well. Now I'm going to move on and talk about types of charts and timeframes. Price action techniques, they're the same on all charts. The price action is the same on all charts. In general, if a trader starts out, a 5-minute chart is a good starting point, and they should avoid trading any chart that has more than 20 bars per hour. In other words, a 3-minute chart if you're talking about a time chart. You can look at this chart. This is a 1-minute chart, and it looks easy. You say, well, it's going up, I'm going to buy. Buy for a second leg. Going down, I'm going to sell. However, Very few traders, even really good traders, can trade it consistently profitably because there are too many decisions and there's too little time. Even though the patterns are good, you just don't have enough time and you'll make mistakes. A trader is much better off if trading a higher time frame chart. Here's a 5-minute chart. They could trade a 15-minute chart, an hour chart, a daily chart, weekly chart. Wedge bull flag, buy. Double bottom, test of the wedge bottom, buy. Bull breakout, high or low, buy. Wedge rally, sell. So there are several clear signals on a 5-minute chart. Now, what about other types of charts, like charts based upon the number of shares or contracts, range charts, or tick charts? So here are those other alternatives. And you can see the patterns are the same. The shape is not perfectly identical. The point I'm making is it doesn't matter what chart you're looking at, a 5-minute chart, a range chart, a 10,000 ticks to a bar chart, 25,000 shares to a bar chart, it doesn't matter. You just pick one chart and the price action will be the same. Simply choose the type of chart that you prefer. I prefer time charts so that I can anticipate when a bar is going to close. I know when there are 4 minutes and 50 seconds, the bar is going to close in 10 seconds. But if I'm trading any of the other types of charts, I cannot anticipate exactly when the bar is going to close. And for me, that creates some anxiety. So I prefer to trade time charts. Now, in terms of time frames, a good way to look at it is simply trade the smallest time frame that you can trade consistently profitably. Again, if you go to a time frame that's too small, you'll make too many mistakes. If you're a scalper, you're only going to hold on to your trade for 1 bar, 2 bars, maybe 5 bars. If you're a swing trader, you're going to hold on to your trade for a lot longer, 10 bars, 20 bars, 30 bars. In general, whether you're a scalper or a swing trader, you should wait until the legs are reasonably good size, 5 or 10 bars, and a pretty good number of ticks or pips. Otherwise, it's just too hard to make money. Whenever there's a reversal, I'm always thinking about 10 bars and 2 legs, TBTL. You don't always get it, but you often do. In general, if I see any kind of a reversal, I look at the highest time frame where the pattern is present. So if there's, let's say, a wedge top on the 5-minute chart, I'll look at the 15-minute chart or 60-minute chart to see if there's also a clear wedge. Then, if I'm looking for a correction, 10 bars, 2 legs, I expect the 10 bars to be on the highest time frame chart. So if the 5-minute chart has a wedge and it takes place over 100 bars, and there's also a wedge on the 60-minute chart, and each leg is 5 to 10 bars, then I look for 10-bar correction on the 60-minute chart, so a day or two of a correction. Here's a wedge bottom on the 5-minute chart. The wedge had 300 bars, so that's actually several days of trading. Am I only expecting a 10-bar, 2-legged correction? No. I'm going to go to the highest time frame that has this wedge pattern and then look for 10 bars on that time frame. For example, maybe I'll look at a 60-minute chart. Here's the 60-minute version of the 5-minute chart that I just showed. You can still see the wedge, and the legs have 5, 10 bars or more. When I see a reversal from the wedge bottom, I'm expecting 2 legs up on the 60-minute chart, and I'm expecting at least 10 bars up. There's at least 5 here, at least 5 here, so the whole pattern has at least 10 bars, has more than 10 bars. But in general, that's my minimum objective for a reversal. So I look for the highest time frame that has the pattern, and then I expect 2 legs and 10 bars on that highest time frame. And that will obviously have far more bars and probably more legs on the 5-minute chart. But when I'm looking for the reversal trade, my goal is going to be 10 bars, 2 legs on the highest time frame. So I don't want to exit too early on the 5-minute chart. Now, what's the best chart if you're trading Forex markets? Well, during active times of the day, like in the middle of the US session or the European session, it doesn't matter what type of chart that you trade. So for example, look at these 2 charts. They're different charts, but they look pretty much the same. During the US session, this is California time. It's between about 5:30 in the morning until 9 o'clock in the morning. It doesn't matter what type of chart you use. For example, here's a 5-minute chart, and this chart has 300 ticks per bar. And the charts look the same. Another thing about 5-minute charts is I can look at a 5-minute chart all day, and if volume is slow on a tick chart, I have to increase the number of ticks per bar. If volume is very big, I have to decrease the number of ticks per bar. Otherwise, the patterns just don't fit on the screen, or they look too small or too big. And with a 5-minute chart, I do not have to do that. Very often during the quiet hours, like between the end of the US session Forex trading session and the start of the Asian session, the market becomes very quiet. You can see we're getting gaps, little dojis, very little trading is taking place here. In fact, the entire time on the 5-minute chart here, this is the Asian session, very little is happening. And as an alternative, you can switch to a tick chart, and this pink box is this pink box. Very few trades, so very few ticks, and this is the same time on the tick chart. So sometimes looking at a tick chart, you can see what's going on more easily than you can on a 5-minute chart. In general, if the 5-minute chart looks like this, I'm not going to trade on the tick chart or any other chart. I'll just wait. Very often in Forex markets, in between sessions, the markets are really not tradable, and it's better to just wait. The tick charts, they compress the data, but it's still better not to trade when the range is that small and the bars are that small. You can trade a higher time frame chart, like a 60-minute chart or a 4-hour chart or a daily chart, and plan to hold for a day or more, but I would not be trading 5-minute charts or 300 tick charts. Again, the dollar versus the Canadian dollar 5-minute chart, and here's a 60-minute chart, and this pink box on the 60-minute chart is this orange box on the 5-minute chart, and you can see virtually nothing is happening. You have very tiny sideways bars, and although this looks like it's moving a lot, it's really not moving all that much. This entire range is less than 10 pips, so it's not tradable. I would not trade it. Your alternative, look for trades on the 60-minute chart or wait for the 5-minute chart to become more active again. Or, of course, you can always look at other Forex markets. Sometimes one market will be quiet and another one will be pretty active. Now, what's wrong with using a very small time frame? High-frequency trading firms are always using very small time frames, and they make a lot of money, or at least a lot of them make a lot of money. And the advantage of a small time frame is the bars are small, the moves are small, and the risk is small. For example, this is a tick chart, and every tick is plotted on this chart. You can say, wow, I could buy here and I could sell here and make a lot of money. Well, look at this. The entire range is only 3 pips tall. So if you're a computer, sure, you can make a pip or two once or twice, but if you're a trader trying to do this manually, you are not going to make money when the entire range is only 3 pips tall, even though the pattern looks very tradable. You have to be a computer. A person is going to lose money if they try to trade something like that. I've noticed that a lot of websites recommend manual high-frequency trading. They don't call it that, but they're talking about trading a 1-minute chart or a 20-tick chart. That is manual high-frequency trading. And the vast majority of great traders cannot make money on that type of trading. Remember, if you're doing this for a career, you're planning on doing it year after year after year, and very, very few traders can consistently make money on a 1-minute chart for years at a time. Your account will slowly disappear. Here's a 1-minute chart of the euro versus the dollar. But look at the range. What's the size of the entire range? All kinds of legs up and down. But the entire range is only 9 pips tall. If you try to trade this, you will lose money. Don't waste your time, don't waste your money doing that. What's wrong with a 1-minute chart? Why does it fail? The risk is small because the bars are small. So you can say, well, I'll buy here and I'll put my stop here and I'm just risking 3 pips, 2 pips, 1 pip. And when traders start out, they focus on risk. All they care about is avoiding loss. However, you also have to be thinking about probability, and that is a very difficult concept for traders starting out. And if you do not have high enough probability, then it doesn't matter how small your risk is, you will lose money. So the logic is good. If you have a winning system that works on the 5-minute chart or the 60-minute chart, why not put it on the 1-minute chart and make money 50 times a day? Well, there are problems with that logic. One of the big problems is time. It takes time to decide to take a trade. It takes time to place the orders, to adjust the orders, and it takes time to manage the trades. And our brains are not built to make that many decisions correctly in such a short period of time. And as a result, traders will make far too many mistakes to make money. Therefore, it's not possible for almost all traders to do this well, trading a 1-minute chart. Remember, if you're doing this for a career, you're planning on doing it day after day, year after year, and it's just really hard to do. You might be able to do it for an hour a day, but to be doing it all day long for years, it's really hard to do. Before trying a 1-minute chart, I would try to get profitable on a higher time frame chart, like a 5-minute chart or a 60-minute chart. If you are profitable on a 5-minute chart or 60-minute chart, I would rather have you increase the size of your position than decrease the size of your time frame. It's a much better idea to increase your position size, and you will make far more money doing it that way than reducing your time frame. Instead of saying, oh, I'm making $1,000 a day on a 5-minute chart. If I switch to a 1-minute chart, I'll make $10,000 a day. I would say if you're making $1,000 a day consistently on a 5-minute chart, keep trading the 5-minute chart because you're proving that you're trading it well. And instead of switching to a 1-minute chart, you're doing the 5-minute chart well, just increase your volume. For example, here, let's say you got a pretty strong reversal down. You got 5-6 bars without a bull body, and then you got a follow-through bar after a bear breakout. Sell the close of that follow-through bar and exit at the end of the session down here. You make 40 pips profit in the Forex market, the euro versus the dollar. So if you're trading 10,000 units, you can say, well, 10,000 units, I'm only going to make $40 on that trade. Right. But if you do it well enough, long enough, you can gradually increase your position size, and maybe at some point you trade 1,000,000 units, and then you're making $4,000 a day. Years ago, a big problem with all trading was slippage. And traders sometimes worry when they start out, oh my gosh, if I trade 2 contracts in the E-mini, can the market handle that? Will I get slippage? Well, here's some time and sales data, and take a look at this. Here's the size of the most recent trades. And what do you see? You see a lot of trades with hundreds of contracts. Here's a trade with 1,000 contracts. And they're not moving the market. Price is barely changing, even a tick. You do not have to worry about trading too big a position size. Slippage in the E-mini, it's rarely ever a problem. It's a problem with some small stocks, but most major stocks, Apple, Google, Amazon, it's not a problem. And most major Forex markets, it's not going to be a problem either. In this very short window, just a matter of seconds, there was huge volume being traded. So you do not have to worry about getting too big for the market. I have to say one other thing about slippage. When you look at time and sales from a broker, there are all kinds of problems with their time and sales charts. Some charts only show limit orders, others have mistakes. For example, look at this. 37,000 contracts traded right here, and the market didn't even move a tick. Do you think 37,000 contracts really traded? Of course not. That's probably an order that was filled over the course of an hour or two, and when the final piece of the order got filled, the time and sales showed the fill. Or it could simply be a mistake. In this video, I talked about false beliefs. The most important one is that there are perfect trades. Another important one is that there's a perfect time to enter. There are no perfect setups, and you can enter at any time all day long, because institutions are entering, buying and selling all day long. And then I talked about the big picture. You want to buy low, hoping that the market will go higher. You want to sell high, hoping that the market will go lower. Finally, I talked about the types of charts and the time frames. It doesn't matter what type of chart that you use. They're all based upon rational human behavior, and they're just representations of the same underlying thing, the trading that is going on. And for time frames, traders should not be trading on any chart that has more than 20 bars per hour. If you're a day trader, a 5-minute chart is a good starting point. This is Al Brooks. Thank you for watching the Brooks Trading course. This is the first of 2 videos on starting out as a trader. This is Al Brooks. Thank you for watching my Brooks Trading course. This is the second of 2 videos on starting out as a trader. I first want to talk about how to advance as a trader. Next, I'm going to be talking about some emotions. In particular, I'll be talking about fear, greed, and uncertainty. When you start out, I think it's better to be pretty selective and look for only the 1 or 2 or 3 best swing trades of the day. Buying low, maybe selling high, buying low, selling high. Buying a 50% pullback. I know it's more than 50%, but it's about a 50%. We have a double bottom. We have a breakout below a double bottom that's reversing up, and it's around a 50% pullback. And then again, another 50% pullback here. 3 pushes up, 1, 2, 3, so a wedge top with a decent sell signal bar. Look for trades like that. I talk more about these in the video on best trades. Think about this for a second. If you start out making just 1 point a day in the E-mini, and then you work your way up to 10 contracts per trade, then that translates into $100,000 a year. If you get up to 25 contracts, that's $250,000 a year with just a single point per day. And if you ever get up to 100 contracts, that translates into $1 million of profit. If you make only 10 pips a day in the euro versus the dollar or any other Forex market, and then you trade 500,000 units per trade, that comes out to about $100,000 profit a year. If you work your way up to a bigger position size, like 5 million units per trade, that becomes $1 million per year on a single 10-point scalp per day. The key is you have to learn how to read the price action. The price action is created by institutional traders. It's their footprints, and you can see what they've done, and it gives you an idea of what they will be doing. You want to be able to structure your trades in a way that you're paralleling the action of institutions. For example, look at the bulls who bought here. They're disappointed by that bear bar. They hold long during this bull bar, and then they get another disappointment bar at the top of a trading range. So you know the bulls are going to sell out of their longs, or a lot of them will. They're disappointed. And aggressive bears will short as well, expecting the bulls to sell. So if bulls are selling and bears are always selling, it's a good setup, and they're shooting for maybe a 10-pip profit, and they'll get out somewhere down here. I want to talk a little bit about emotions. Most of the trading that takes place in any major market is being traded by computers, computer algorithms, and they use many variables, and they're based entirely upon math. When I say emotions are not variables that the computers consider, that is not entirely true, but for the most part it's true. For example, some computers will look for words like fear or anger or depression or overbought or oversold, and they'll count the number of times those words are used in maybe Twitter over the course of the past 5 minutes, and they will make trades based upon that. But in general, the computers are basing their trades based upon the charts, not on emotions. So if you are having any kind of a feeling at all that is taking your attention away from trading, if you're worried, if you're greedy, if you're hopeful, if you feel restless, if you feel uncomfortable, if you feel confident, if you feel anything at all, you will be unable to structure trades the way the computers are structuring the trades, and you will lose money. Everyone has feelings. You can't avoid it. But there are things that you can do to try to reduce their effect on your decision making. One important thing is if you care about losing money, if you're worried about losing money, if you're thinking about losing money all the time, you're not going to be objective, and you will not be able to see what the institutions are doing, and you will lose money. A good way around that is to trade the I don't care size. You trade small enough so you really do not care. And then once you decide on a size, trade maybe only 25% as big as the I don't care size. In other words, you trade very, very small. One of the advantages of trading Forex markets when you start out is that you can adjust your position size to any size position, and you can trade it with a very small account, and you can trade a very small position size. It makes it easier to trade the I don't care size. Let's say you see a wedge, 1, 2, 3, 3 pushes up, and you sell on the reversal down. First of all, that's not a good trade. You have about 8 bull bars here, a very strong bull breakout, and we're getting higher lows and higher highs. Yes, it's a wedge, 1, 2, 3, but I would wait for at least a second entry short. But if you did take that trade, and you trade small enough, even if you did finally give up here, your loss would not be all that big. So it gives you an opportunity to learn. You want to make sure that you're trading small enough so that your losses are not upsetting and preventing you from doing what you need to do. Fear and greed, these are emotions you hear all the time when people talk about the stock market, but many other emotions are important as well. They're really just theoretical concepts, and they do not exist in the trading world. Most traders, most professional traders who are making money, don't continue to oscillate between, oh my gosh, I'm so afraid, and oh wow, I'm making a lot of money, I gotta make a lot more. That kind of stuff belongs in the movies, and traders really don't think about them. As far as fear and greed go, they're really not important to a professional trader. A beginner definitely has fear. And what is a beginner fearful of? Well, they're afraid of losing money because, in their eyes, it's the equivalent of death of their dream as a trader. They saved up enough money to allow them to try trading to see if they could make it as a professional trader, and losing money to the point that their account has so little money that they no longer meet margin requirements and they're no longer able to trade, that's the equivalent of death. They're also afraid to be seen as an addict or a weak person or a gambler. And it's really not fair because let's say you're a real estate investor and you buy an apartment complex and then you sell it 3 years later and you buy another apartment complex. Well, guess what? You're a trader. Your time frame is just 3 years between trades, and it's no different from a forex trader or an e-mini trader taking a trade and exiting 5 minutes later, 10 minutes later. All that's different is the time frame, and everybody is a trader. Beginners are also afraid of the feelings of their spouses. They don't want their spouses to become impatient, angry. When are you going to start making money? When are you going to stop losing money? And then another fear that a lot of traders have, but they don't realize they have, is that they are afraid of becoming more successful than they think they deserve to be. And that can hold them back. So they'll intentionally sabotage themselves because they're afraid to see themselves as an excellent trader making a lot of money. When traders are afraid, I think it's usually because traders do not understand the markets and they do not understand themselves. A professional trader just looks at the market and doesn't get upset by anything. He just accepts that anything can happen at any time. For example, here, look at the size of this drop. This is the euro versus the Swiss franc, and it happened overnight, and a 20% crash. To a professional trader, he'll look at that and say, I haven't seen that in a while. Whereas a beginner will look at that and say, oh my gosh, the euro is crashing against the Swiss franc, and who knows what's going to happen after this. It's going to be disastrous. To a professional trader, no big deal. And he'll say to himself, I haven't seen that in a while. That's how professional traders look at things like this. They just don't get upset about it, and then 2 days later, the professional trader is on to the next trade, and he's not even thinking about this anymore. Skilled traders, they're never afraid. They understand what's going on. They understand that the probability of anything is rarely more than 60%. So that means usually, most of the time, they're going to be wrong 40% of the time. So they just don't get upset. They understand what makes a reasonable trade. They know how to manage their trade, and they can handle anything that comes their way. They also make a point to minimize their risk. They never let their risk get beyond a certain point. They know that when they enter a trade, they make sure that they take a position size, allow for scaling in if they're scale-in traders, and they make sure that the total risk on any trade, even a trade where they do scale in, is no bigger than on any other trade. Skilled traders, they're confident that they can handle anything, even a crash. And as the price action unfolds, they get more information. They go through a mental checklist and they do what is appropriate, including exiting and waiting. Why no greed? Because they understand the math. If the profit is good enough for the probability and the risk, they'll always take some off, and the result is a pullback, or at least a pause. They buy this for a second leg up, strong bull breakout, pullback. They buy a high one, bull flag, a little pullback, and they see the market stalling. A lot of traders will take some profits here, and they'll take profits here, and that's what's causing the pullback. They try not to get greedy. They always take some off when they have good profits and it appears that the market is at a resistance level and might be stalling. Greed, when a person is greedy, they want more than what is logical. You cannot make money if it's illogical. You have to have a logical approach to management, otherwise you're going to lose. So you just stay calm and you just be objective and you use logic to guide your management. Now, I said that all traders, all good traders, are fairly immune to emotion, but they obviously are always feeling something, but they're very good at not letting emotions influence their decisions. However, emotions can be useful. You can use them as radar to find opportunities. They tell you what the market is doing, and that gives you an idea of what to do at any given moment. In particular, when traders are confused, that is an important feeling. Confusion, uncertainty, very important to a trader, and your radar needs to be able to detect it. When you're starting out, it's easy to be confused because you're confused all the time. But even professional traders get confused. That simply means that the probability is not as high as traders want it to be, and that usually means that the market is not going to go too far up and not going to go too far down. If the market's not going to go too far up and not going to go too far down, then traders expect a trading range. So it's important to sense when you are confused, when you are uncertain, when you're disappointed. If you're selling and then the market reverses up strongly, you're a disappointed bear. If it's rallying strongly and it reverses down, you're a disappointed bull. And uncertainty, confusion, disappointment, bad follow-through, those are all signs that the market's in a trading range. And when it's in a trading range, you expect the opposite. You expect breakouts to fail. So no matter how strong the market is moving down, you expect it to go up. No matter how strong it's going up, you expect it to go down. And you trade it that way. You buy low, you sell high, and you scalp. This is very different from over here. Here, traders are uncertain. They're not sure what the market is doing. They are pretty certain that it's not going to go too far up or too far down, and they're disappointed by the follow-through. That tells them that the market's in a trading range. On the other hand, let's say you see this. 4 bars up, 5 bull bars, 6 bull bars, gaps between the close of the bar and the high of the prior bar. There's a sense of urgency, like, oh wow, I gotta buy. That is a feeling. That sense of urgency is important, and when you have it, you gotta get into the market. Even if you trade very small, it's really important to get in as early as possible. It doesn't matter if you buy here or here, you're still almost certainly going to make money. However, it's easier to make money if you buy early on. Your risk is less and the profit potential is more. So you use these feelings to make money. Uncertainty and disappointment, if that's what you're feeling, that tells you that you believe the market is in a trading range. And in a trading range, you want to be buying low. You buy to buy back a short or to put on a long. You sell high to sell out of a long or to put on a short. And you take quick profits because you believe the market is not going to go very far. On the other hand, if you have a sense of urgency, like, oh, I got to wait for a pullback, this is going up far too fast, and my stop is too far away, I don't want to risk that much. Whenever you have that sense that you're missing a strong trend, the best thing to do is just trade immediately at the market. Buy at least a small position, use the appropriate stop. So that sense of urgency is telling you that you have to get into the position. In this case, you have to get long at least a very small position. You're waiting for a pullback and it never comes, or when it comes, it's too small, and you end up waiting, and you end up missing a huge trend. As soon as you start hoping for a pullback, that's the time to buy at least small. Your stop is obviously down here, so you just trade a size that is appropriate for a stop at that location. And it doesn't matter how you buy. You can buy closes, you can buy at the market, you can buy below bars, you can buy above bars, you can buy a bear close here, betting the bear reversal will fail. It doesn't matter. You just have to get long. You can buy a trend resumption up, you can buy above a bull bar, we got a pullback here, buy above the high of the bull reversal, betting that the trend is about to resume, so you can buy with a stop order. Now, can anyone really make money? Sure, lots of traders make a lot of money. Some students are extremely profitable. I get emails from traders regularly telling me that they're making a lot of money. And so yes, it's possible, but it takes a lot of work. And the websites that make it sound like it's easy, you just spend a couple weeks learning a few things. I just don't believe that that's possible. That's why I have so many videos here. I'm trying to provide the information that a trader needs to really be successful. The traders who are making money, they study. After the market closes, they make notes. They go back to my video course, to my books, to any other reference information that they have. They look at charts that they've collected over time and made notes on. They're constantly taking notes until they learn how to trade profitably, until things are pretty much reflexive. You don't have to be perfect. All you have to do is be consistently good. So the goal, obviously, is to make money, but don't worry about being perfect. Only look to be good. Here are some actual emails from traders who have studied the course, and these traders have done very well. In this video, I talked about how you start out as a trader and how you progress. In particular, how you can make a lot of money if you get consistently profitable and simply increase your position size. And then I talked about emotions and how computers, for the most part, ignore them, and traders have to learn how to minimize them. However, your feelings are a radar, and if you're feeling a lot of fear and greed, that tells me that you're starting out and you're worried about the wrong things. You're probably trading too big. You should trade I don't care size. On the other hand, if you're feeling uncertain or confused, the market is probably in a trading range, so you should trade like a trading range. If you feel like the market is racing up or down and you're waiting for a pullback to enter, there's a sense of urgency. Then you have to trade small and enter at the market. This is Al Brooks. Thank you for watching the Brooks Trading course. This is the second of 2 videos on starting out as a trader.